Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, June 4, 2026. We're Elena and Marcus. Imagine you run a company that just beat its quarterly earnings expectations.
Yep.
You're sitting on a massive, $30 billion backlog of guaranteed orders. You are right at the absolute center of the artificial intelligence boom.
Yeah, and yet the moment the market opens, Wall Street punishes you with your worst single-day stock drop in over a year.
Exactly. And if you're looking at your portfolio today, you might be scratching your head wondering why your tech stocks are bleeding while your bank stocks are hitting all-time highs. I mean, that is the reality of today's market.
It is. Looking at today's data deck, it really points to a highly fragmented, complex landscape defined by three critical themes. First, we are tracking a very violent intramarket rotation.
Right, that Broadcom guidance miss. It triggered a sharp unwind in the AI and semiconductor complex, but the damage was, well, it was strictly contained to tech.
Yeah, capital aggressively rotated into old economy cyclicals, which actually pushed the Dow to a fresh all-time high. Then second, we're observing clear labor market softening paired with a pretty significant rally in government bonds.
Jobless claims missed expectations, driving front-end treasury yields lower ahead of tomorrow's critical non-farm payrolls report.
Yep. And third, we are watching a geopolitically driven crude oil sell-off, a fragile conditional ceasefire announcement between Israel and Lebanon sent crude sliding today.
Despite immediate pushback from the involved parties, right? Well, we're going to dissect the mechanics of all three of these themes, starting with the broader macro environment.
Yeah, so the primary macroeconomic driver in today's session was undoubtedly that rates rally. It was triggered directly by the softening labor data. According to our daily desk data, initial jobless claims hit 225,000.
Which is noticeably above the 215,000 consensus.
Right. It marks the highest level of claims we've seen since February. And concurrently, the NFIB small business hiring plans dropped to a 6-year low.
Wait, a 6-year low?
Yeah, just 9%. Only 9% of small businesses are planning to hire right now.
Okay, so that dual signal of a cooling labor market, it drove a rally in the front end of the curve. The 2-year Treasury yield fell 3.7 basis points to 4.047%, and the 10-year yield dropped 2.0 basis points to 4.473%.
It did.
But before we get into the global implications, let's apply our first principles rule right here. For the regular investor tuning in, break down the mechanics of this move. Why exactly do short-term Treasury yields drop when jobless claims rise?
Sure. It fundamentally comes down to how institutional capital anticipates central bank policy. When unemployment claims rise, it suggests the broader economic engine is starting to cool down.
Right.
And the bond market interprets this cooling as a clear signal that the Federal Reserve will eventually need to lower its benchmark policy rate, to stimulate the economy.
And the 2-year Treasury is highly sensitive to the near-term Fed moves.
Exactly. As expectations for future Fed rates fall, the yield on newly issued short-term debt drops to match. So if you're an investor, you rush in to buy these bonds today to lock in current yields before they fall any further.
Which drives the bond price up, and since price and yield move inversely, the yields drop.
Spot on.
That makes logical sense, but there is a glaring contradiction in today's desk data here. While the 2-year yield dropped, the OIS curve is telling a completely different story.
Yeah, the overnight index swaps.
Right. Wall Street's betting market for where Fed weights will be. Right now, OIS implied Fed pricing actually reflects a consensus that the Fed's next move could be a hike.
Right, with an implied weight rising to 3.871% by March 2027.
Exactly. And that's driven by hawkish commentary from Fed officials Logan and Schmidt. I mean, it's like driving with one foot slammed on the gas and one on the brake. Does the market actually believe a cut is coming, or is this just aggressively hedging against a policy error?
It's predominantly a hedging mechanism. The OIS curve reflects this higher-for-longer consensus. The market recognizes that inflation risks haven't totally dissipated.
Especially with global supply constraints.
Exactly. When officials like Logan and Schmidt lean hawkish, it creates binary policy risk. So the drop in the 2-year today, that was a tactical algorithmic reaction to labor data. But that elevated OIS curve shows institutional capital is heavily protecting itself against the Fed being forced to hike again.
We also have to put this into a global context because rates pressure remains high internationally. Bank of Japan Governor Ueda delivered a hawkish speech today that raised the probability of a June hike.
Which puts USD-JPY at a critical watch level of 160.02.
Right, and that carry trade dynamic is huge. Moving to today's data regarding equity flows, we saw extreme sector dispersion play out in real time.
Yeah, I mean, the S&P 500 eked out a 0.41% gain, closing at 7,584.
But that calm headline masks the violence under the surface. Broadcom completely collapsed, down 12.6% to $418.91.
Right, following their earnings report. Their third quarter AI chip revenue guidance of $16 billion just missed the street's $17.2 billion estimate, and they failed to raise their 2027 AI guidance.
Which dragged CrowdStrike down 3.8%, the Nasdaq 100 down 0.54%, and the SOX down 2.1%.
But conversely, the Dow Jones surged 1.73% to an all-time high of 51,562.
And the Russell 2000 jumped 1.45%. Citigroup surged 4.0% to hit an 18-year high. Goldman Sachs gained 5.0%, leading the XLF to a 2.60% day.
When you look at investor flows and positioning in our latest run, asset managers were net sellers of tech and consumer stocks.
They used that supply to fund demand in macroeconomic products and communication services.
Exactly. And hedge funds were fundamental institutional buyers of industrials, real estate, and financials. This confirms a genuine rotation in short covering in cyclicals.
Right, rather than a macro risk-off panic. The VIX actually fell 461 basis points to settle at 15.32. But I have to push back on this Broadcom punishment. The market is acting like a strict teacher grading on a brutal curve here.
How so?
Well, they actually beat Q2 consensus. They have a massive $30 billion AI demand backlog. Yet they just suffered their worst single-day decline since January 2025. Does this mean the fundamental AI trade is exhausted? Or has investor tolerance for good but not great guidance just completely evaporated after a 60% rally?
It's definitely the latter. The fundamental demand is intact.
Yeah.
But when a sector rallies 60% from the March lows, the valuation multiples expand dramatically. They price in perfection.
So reiterating guidance isn't enough.
Right. When management just reiterated guidance instead of raising it, the justification for those massive premium multiples fractured. We saw Macquarie downgrade the stock today, though Goldman Sachs maintained a buy and raised its target to $525.
So institutional consensus is divided.
Yeah, that divergence among deal desks creates volatility, but it just confirms a collapse in tolerance for anything less than perfection.
On that point, let's pivot to commodities and hard assets. We tracked notable moves in energy and metals today, driven by geopolitics and the softening U.S. dollar. WTI crude fell 3.0% to $92.93 per barrel.
And Brent dropped 2.1%. This sell-off was driven by headlines of a conditional ceasefire between Israel and Lebanon.
Right, the market quickly priced this as a potential stepping stone to a U.S.-Iran deal that could reopen the Strait of Hormuz. But we need to maintain strict neutrality and just look at our daily desk data here.
Yeah, the ceasefire remains highly fragile.
Highly fragile. Hezbollah explicitly rejected the terms, calling it a farce. Israeli strikes continued, and Iran stated there's been no tangible progress in U.S. negotiations. So objectively, the market's oil sell-off may be entirely premature because the geopolitical risk premium isn't fully resolved.
Right, but algorithmically, the immediate 3.0% price drop was almost entirely headline-driven.
Well, meanwhile, gold rallied 0.9% to $4,475 an ounce, and silver rose 1.6% to $73.88 an ounce.
Both buoyed by dollar softness, with the DXY dropping to 99.44.
But this exposes a logical inconsistency. If the market genuinely believes in the ceasefire enough to dump crude oil by 3%, why are investors simultaneously bidding up gold, the ultimate geopolitical safe haven, by almost 1%? Are commodities sending mixed signals, or is gold just reacting to the falling dollar?
It's a combination.
Yeah.
Gold is inversely correlated to the US dollar, so the DXY dropping provides a mechanical tailwind. But the sustained bid in gold tells us that while high-frequency funds were quick to sell crude on the ceasefire headline, longer-term capital allocators don't fully trust the de-escalation narrative.
Understood. Let's bring this all together into the synthesis. We need to connect the cross-asset dots to determine the current economic regime.
Right.
When you look at a front-end rates rally, the Dow hitting an all-time high and high-yield credit with HYG up 0.19%, confirming a risk-on tone in non-tech sectors, it points squarely to a soft landing with rotation regime.
Yeah, despite Broadcom's drag, institutional credit strategy desks note that credit markets are completely ignoring AI-specific stress.
Credit spreads remain very tight.
Exactly, supported by structural demand from pensions and insurance companies.
However, today's proprietary updates highlight some lurking tensions. U.S. money market funds just hit a record $7.894 trillion. And there's a resurgence of redemption pressure in private credit vehicles.
Specifically BDCs like Blackstone's BCRED and Blue Owl funds.
Right, so I have to challenge the durability of today's price action. Is today's aggressive rotation into banks and industrials the dawn of a massive multi-quarter regime shift away from AI megacaps, or is it merely a one-day positioning flush before tech takes over again?
Well, tomorrow's non-farm payrolls will be the ultimate arbiter. It's a binary setup. Our proprietary desk estimates forecast plus 60,000 jobs.
Which is well below the 85,000 consensus.
Exactly. A miss like that could aggressively steepen the yield curve and validate today's rotation, whereas a hot print could sharply reverse today's race rally.
As we wait for that data, consider that staggering $7.894 trillion sitting in money market funds. Is that record pile of cash the ultimate dry powder that will eventually rotate into equities and drive this old economy bull market for years to come? Or is it a glaring signal of deeply entrenched institutional fear, a sign that smart money doesn't entirely trust this soft landing narrative? Thank you for listening to Market Pulse by Orestes Capital. We're Lena and Marcus. We'll be back tomorrow with the latest market color.